A 1-2 punch took the market lower. IBM was a big drag on the blue chip Dow index following the company's disappointing earnings, which we told you about yesterday. Add to that a skid in oil prices, which pressured energy shares, and the result was a decline in the broader market. The Dow Jones Industrial Average lost 118 points to 20,404. It's the second straight triple-digit decline. The Nasdaq rose 13 and the S&P 500 fell 4. A surprise increase in gasoline inventories wiped about 4% off the price of domestic crude. Today's decline in stocks follows a pattern that we've seen for nearly 2 months. And as Bob Pisani reports, there are reasons for the slide.
There's a dangerous stew of uncertainty for stocks right now. First, fiscal reforms are being pushed out. The honeymoon is over on tax cuts and less regulation and infrastructure spending. The president said he was working on tax cuts yesterday. The markets ignored him. Second, weaker hard economic data is very visible, from retail sales to the consumer price index to the producer price index. Economic data has been weaker than anticipated recently. The odds for a Fed June rate hike are now down to about 45% from close to 60% a little more than a week ago. Third risk, geopolitical risk, the French election, a tougher stance on Brexit from the UK, and particularly North Korea, were all background stories until the last few weeks. This weaker data and this geopolitical risk have put downward pressure on bond yields. That's another problem. Finally, there's earnings risk. This is new. Stocks are expensive. The risk is to the downside. This leaves stocks very vulnerable to a sell-off, particularly if there's even the slightest hint of an issue. Just look what happened to Goldman Sachs yesterday. Look at what happened to IBM today. The worry is that the first quarter might represent the peak for earnings growth, which is now about 10% for the first quarter. Now, there's no panic yet, and this could all change if we get stronger second quarter GDP data and the Fed does indeed raise in June. That would almost certainly push bond yields higher, and a lot of these issues would go away. But for right now, it's a very tricky moment for the markets. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.